Chapter 4, we're going to really discuss two component parts to this. The first one is we're going to talk about cash flow. Not just the importance of cash flow and the concept of cash flow, but we also actually will calculate the cash flow for a corporation. The second part of the chapter will discuss the concept of financial planning. Now, we're not going to get into a great deal of detail with financial planning, but we will discuss the concepts and the techniques involved in financial planning. Now, when you go to the website, the Thomas More website, the TMC, the Weebly site, excuse me, there are videos that will walk you through step by step the free cash flow calculation and also the pro forma analysis for a company. So let's go ahead and get started. I mean, cash flow, we've talked about this in the beginning, that's what we want to talk about. That's the variable that we use. On the accounting side, where would you find cash flow? There is a cash flow line item that's discussed as the statement of cash flows. But we want to talk about cash flow from a little bit of a different perspective. There are two cash flows that are ultimately important from a financial perspective. The first cash flow is something called operating cash flow. This is used by management and also is a indication of the cash flows generated from running the company. Free cash flow is a number that's really much more monitored by the capital markets, and we'll give you a definition of that here in a little bit. But these are the two different cash flows that we will ultimately be calculating for a corporation. What makes cash flow different from profits are the line items that are described as being non-cash expenses. The primary one that we're going to discuss is depreciation. The IRS allows us to write off the assets of a company over time so that we can follow the matching principle of accounting, which matches the cost of the asset to the profits generated by that. Now, what we're going to talk about and calculate are things called, for tax purposes, is something called MACRS. It's a very easy type of calculation method, and we'll talk about it in class. We'll go over some examples, but it is what's done for tax purposes. Now, depreciation does not necessarily have to be done this way. On the financial side, typically they use straight line depreciation. So there are really two different ways that we account for the depreciation of a company. So here we have a company, we have a new asset, new machine, cost $38,000, and it has cost $2,000 to install it. Ultimately, when that machine's retired, we're going to be able to sell it for $1,000. So the first question is, what is the depreciable value of this machine? Well, regardless of whatever its salvage value is, it's not part of the MACRS calculation. The depreciable value is $40,000. The formula for depreciable value is the cost plus whatever it costs to get the asset up and running. So in this case, $38,000 plus $2,000. Under the MACRS system, we're going to be provided with some information. We're going to have to be provided with, number one, what kind of asset is this? What is its, in quotes, property classes? The IRS designates each asset as having a certain lifespan, if you will, or depreciable life. Once we know that, we can then follow the guidelines and then ultimately calculate what's referred to as a depreciation schedule, a table that gives me or identifies the actual depreciation per year of the asset's life in the company. So here are the property classes. A 3-year asset are things like research equipment, etc., things with very short lifespans. A 10-year asset would be, more manufacturing types of assets. A light-duty truck is depreciated over 5 years. Cars, 5 years. Office furniture, though, is 7 years. So, again, you don't have to memorize this, but there are, in the IRS code, you can look up and find what these property classes are to see where the new asset falls in this MACRS system. Once you know where it falls, there is another table that's generated that tells you what depreciation to take each year. So if you have a 5-year asset and you bought it 2 years ago, this past year you were able to depreciate it for 32%. The next year you would depreciate the depreciable value, the depreciable basis, for 19%. So this identifies the depreciation that can be taken each year that the asset is held with the company. And what you can see is at the end, regardless of what the lifespan is, 100% of the asset's depreciable basis is depreciated. So here we have a company that has a $40,000 asset. It's a 5-year MACRS asset, and here's how you would depreciate it. The depreciable basis is $40,000. The very first year you take $20,000, that's $8,000, or 20%. In the 5th year you could take 12%. 12% of $40,000 is $4,800. So at the end, if we add up all the years of depreciation, $40,000 is exactly what we depreciated on this asset's life. So this depreciation is what gives us the difference, because these are expenses that are taken moving forward after we've actually purchased the asset. So where do we find cash flows? Well, in the accounting sense, we can find those cash flows on the statement of cash flows. And if you remember, we talked about operating inflows or operating cash flows, investment flows, and financing flows. That is the accounting and the formal journal entry system of calculating this statement of cash flows. What we want to look at, though, is something a little bit different. Again, we saw this table before. I don't want to harp on this table, but for this particular company, right, here's the cash that came in, $780,000 from operations. They spent $300 on new assets through their investment activities, and in the end, they actually received $20 net from their financing activities. So in the end, they ended up having 780 plus 3 minus 300, that's 480. Add the 20. The net increase in cash to the company was $500. But again, we want to change just a little bit different. We want to start thinking more about decision making. So the first cash flow we want to calculate is something called the operating cash flow. It's a very simple designation, a simple calculation. The first thing we need is net operating profit after taxes. So we take the EBIT of the company, earnings before interest and taxes, and subtract from it the taxes of the company. So the operating cash flow then is this net operating tax, not net operating profit after tax, and you add depreciation to that. So this designates then the cash that's generated from normal operations. So we don't have to worry about selling off parts of the company, etc. This only comes from normal operations of the company. So for this particular company, we had $370 was the tax. Add the profit, the depreciation of 100. So for this end, we end up with an operating cash flow of $322. So at least from this perspective, the analysis says at least this company is generating positive operating cash flows. It's creating cash from running the company. Now, free cash flows, though, is really more of a number that's more closely followed by the investors of a company. It identifies the amount of cash that's available to investors. So who are the investors of the company? We have to include both creditors and owners. So free cash flow is that operating cash flow minus the investments of the company. Well, the company can invest in fixed assets and it also can invest in current assets. So the net fixed asset investment is the change in net fixed assets plus depreciation. The net current asset investment is the change in current assets minus the change in accounts payable and accruals. Now we'll talk a little bit about why this is important as designation. Why don't we just use current liabilities? But in the end, what we want to do is we only want to look at those items, those current liabilities that are non-interest items, because we want to look at the cash available to creditors and owners. So anything that has an interest associated with it, we don't want to incorporate in this calculation. So the next fixed assets for this company ultimately was $300. The current asset investment net was $0. So the free cash flow of the company was $22. So again, what this means is that after we paid for all the expenses of the company, all the utilities, all the labor, everything is paid for, the marketing, the advertising. We've even purchased plant and equipment, and we've had some changes in our current liability and asset base. After that's all over, we have $22 left over to pay to investors. So how could we do this? We could use this for dividends. We could use it to make additional interest payments. We could use it to buy back stock. We could use it to buy back the debt of the company. Again, investors are interested because it gives them a sense of safety. How safe do they feel about the future of their expected cash flows? So we're at Cisco here. We can see that they reported earnings per share of 42 cents. The Wall Street experts had predicted 39 cents. But one analyst observed that of the 3 cents that they beat the forecast, one of those cents could be attributed to the fact that there was a difference in the calendar. Another penny was attributable to some tax gains, some unusual tax gains. And the third one was classified as the somewhat vague other income thing. So when the text talks a little bit earlier about free cash flow is really looked at by investors, it's really a more reliable measure of income. Obviously, because there's fewer things we can hide, but it looks at the entire spectrum of all the cash that's spent on the company and what is out there and now available for shareholders.